Hey everyone, welcome back to Corporate Decoder. Today WETOU.CH Technology Inc. just filed its quarterly report, a 10Q, and I am seeing higher profits but a widening gap in something important. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is making more money, but their sales are heavily concentrated among just a few customers, which always makes me a bit nervous. Alright, let's dive into what WETOU.CH Technology Inc. has been up to in the first quarter of 2026. This is a company that makes touchscreens for all sorts of devices from financial terminals and cars to medical equipment and gaming machines. They operate mostly out of China, and as we often see with these companies, currency changes can really impact their numbers. Looking at the top line, revenues for the first 3 months of 2026 hit $16.3 million. That is an increase of about 6.5% compared to the same period last year when they brought in $15.3 million. The company says this jump was due to a small increase in the number of units they sold, a tiny increase in the average price they charged for their products, and also a boost from the exchange rate since the Chinese yuan, or renminbi, has gotten stronger against the US dollar. Most of their sales, about 67.5% in this quarter, come from mainland China. Revenue from China grew by 6.8%, thanks to a slight increase in their average selling price in Chinese yuan, again helped by that favorable currency exchange rate. Interestingly, even though they sold more of the higher priced medical and automotive touchscreens, the total number of units sold in China actually went down a little bit. Their overseas sales made up about 32.5% of the total, bringing in $5.3 million, up 6.0% from last year. This growth was driven by more sales of automotive and gaming touchscreens, and similarly, the stronger Chinese yuan helped here too. These overseas sales are spread across places like Taiwan and South Korea. The company also noted they are shifting their product mix towards higher-end screens like medical and automotive touchscreens, which makes sense as these often command higher prices and have better growth potential, especially in China. So overall, revenues are up, which is always a good sign. Now let's talk about profitability. Gross profit, which is what is left after deducting the direct costs of making their products, was $5.8 million. While this is a small increase of 1.8% from last year, their gross profit margin actually decreased a bit. It went from 36.9% in the first quarter of 2025 down to 35.7% in the first quarter of 2026. The company blames this on higher labor costs because they hired more technicians and slightly higher material costs. Even though they are selling more high-end products, the increase in their costs is eating into their profit margin. Selling expenses more than doubled, going from $0.1 million to $0.2 million. This is mainly due to more travel expenses to visit clients. It is a small amount in the grand scheme of things, but a big percentage jump. On the flip side, general and administrative expenses, which are things like salaries for office staff, legal fees, and accounting, saw a significant drop. They went from $1.6 million to $0.6 million, a decrease of over 62%. A big reason for this was that a large consulting fee from last year was no longer being amortized, meaning its cost was spread out. However, they did spend more on professional fees this quarter. Thanks to those lower administrative costs and higher revenues, operating income jumped by 24.4% to $5.1 million. Now, income tax expenses went down by 20% to $1.2 million. This made their effective tax rate drop from a high of 36.5% last year to 24.3% this year. This improved tax rate combined with the higher operating income really boosted their bottom line. And that brings us to net income, the profit after all expenses and taxes. WETOU.CH Technology reported a net income of $3.9 million for the first quarter of 2026. This is a significant increase of 50% compared to the $2.6 million they earned in the same period last year. So, financially, on the surface, things look pretty good with profits soaring. Looking at their financial health, WETOU.CH's cash position is strong. They ended the quarter with $120.5 million in cash and cash equivalents. That is up from $118.4 million at the end of 2025. However, here is where a red flag starts to appear. While they reported a healthy net income, the cash generated from their actual operations was only $0.5 million for the quarter. This is a big drop from the $2.0 million in operating cash flow they had in the same period last year. The company explains this by pointing to a large increase in accounts receivable, meaning customers owe them a lot more money, and a decrease in accounts payable, meaning they paid off more of their bills. Essentially, while they are booking revenue, the cash isn't always coming in as quickly, and that increase in accounts receivable is significant. It jumped by $4.4 million this quarter. This means a lot of their reported revenue isn't actually in hand yet. This brings me to a major point of concern. Remember how I mentioned customer concentration? Well, look at this. For the first 3 months of 2026, their top 10 customers accounted for 100% of their total revenue. And last year, it was 99.9%. This is extremely high. It means Wetouch is almost entirely reliant on a very small group of buyers. If even one or two of these major customers decide to buy less or go elsewhere, it could have a devastating impact on Wetouch's revenue and profitability. It is like a chef who only has a few regular customers. If they stop coming, the restaurant is in serious trouble. Adding to that concern, a large chunk of their accounts receivable, meaning money owed to them by customers, is also concentrated. 5 customers make up over 70% of their total accounts receivable. This compounds the risk. If one of these big customers is slow to pay or can't pay, it is a double whammy. They lose that revenue and also don't get the cash they were expecting. Finally, something important to note is under the section on controls and procedures. The company states that their internal controls over financial reporting were not effective at a reasonable assurance level. They've had material weaknesses in the past, and while they are working on fixing them, they haven't fully resolved them as of the 31st of March 2026. This means there is a higher chance of errors in their financial reporting. While their profits are up, the underlying reporting mechanisms still have issues. To wrap this up, WETH Technology Inc. is showing strong profit growth, which is positive. However, the heavy reliance on a tiny number of customers and the ongoing weaknesses in their internal financial controls are significant risks that investors should seriously consider. What I am actually looking for is a clear plan and demonstrable progress in diversifying their customer base and fully remediating those control issues. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.